the Community Development Block Grant Disaster Recovery Program webinar for program planning, admin, and activity delivery costs. My name is Tyler Bridges, and I'm a CPD specialist in the Disaster Recovery and Special Issues Division here at HUD headquarters. Also joining me on this call are staff from the division, including Sandra Donaldson, based in Missouri, Tom Tiffin, based in Alabama, and Marty Horwath, based in Florida. During this webinar, you will have the opportunity to learn more about the distinction between planning, admin, and activity delivery costs and related requirements. We're happy to see that many grantees and partners are on the line, including contract firms and nonprofits. We would note that the primary audience today are those grantees that receive direct assistance from the department, and as such, we will be giving them priority for asking questions. But our goal is to make sure that the broader community also understands these concepts as well. With that, I'd like to turn it over to our host for this afternoon, Marcia Tonkovich.
Thanks, Tyler, and good afternoon, everybody. I'm Marcia Tonkovich with the Community Building Collaborative. We're a small firm that's a subcontractor to ICF, and we do work around CDBG, community development, economic development, and disaster recovery. And I have, I think, met many of you throughout the years on CDBG or NSP or various disaster recovery initiatives. So it's great to be here with you today. So I want to let you know kind of how the logistics will work for today, and then we'll jump right into our content. So we will have a couple of polls throughout our webinar, and I'll be turning those over to Chantel, who will walk you through how to do your voting. And basically, you'll just click on a button, and then she'll read aloud kind of how we did. Many of these polls are meant to be little quizzes on the material that we've just covered. And we encourage you to take a few minutes when you're doing them, if you're in a room with your colleagues, or you could chat with your colleagues, to have a conversation about the questions and the answers. Some of them are meant to provoke conversation as kind of a reinforcement of what we've just covered. In terms of asking questions, we do want to encourage you to ask questions. We're going to stop periodically throughout the presentation. I'm not going to wait till the end. I want to let you ask questions as we get to the material. So feel free to type in a question at any point, and you'll see in your lower right-hand corner of your screen a box that says questions. And if you could go ahead and type in your question with as much context or explanation as you can in the space you have, so that we understand exactly what you're asking. Our screeners may ask you a couple questions back just for clarification's sake, and then we'll answer them at periodic points throughout the webinar whenever we get to one of the blue kind of divider slides in the section. We are going to try to focus on questions that are about the materials we're covering today, and also about questions that apply to policy or procedure or requirements. We're going to try not to focus specific project detailed questions, but I would encourage you, if you have those sorts of questions, to talk to your HUD rep or HUD headquarters and do, get some technical assistance about those questions. So as we said, this is the CDBG-DR webinar series. This is now the third in that series, and there are additional webinars yet to come in the coming weeks. So these are meant to build upon one another and to be, you can watch all of them, we hope. They will all be available on the HUD Resource Exchange, so if you have subrecipients or staff or partners who are not able to be with us today, please encourage them to feel free to watch those or listen to those online. And again, your HUD staff are always available to answer follow-up questions. So our agenda for today, we're going to focus on eligible costs and the rules around costs. So that's a little bit different. I think many of you were with me earlier on our seminar on national objectives and eligible activities. And those are the big buckets of kinds of things that you can do. Today we're going to focus on, within each of those big buckets, what are the specific types of costs that you're allowed to pay for, and what categories, how do you categorize those costs in order to make them eligible. We'll talk about the documentation of those costs, and then we'll close out today with a conversation about program income, because it does tie back to this, how you spend your money. So we have our first poll, so I'll turn it over to Chantel.
Okay, what exactly is your level of familiarity with cost principles? Do you have an accounting, finance, compliance background? Or are you a policy or technical person but generally understand the principles? New to the federally financed programs, or none of the above?
So take just a moment and pick and vote for whichever one makes the most sense for you, and obviously there's no right answer here.
And the polls are now open.
Great, we'll give it just one more minute to finish the voting, and then we'll talk about what you said.
Okay, about 50% of our participants have voted.
Okay, Chantel, so let's go ahead and close out the poll.
Okay. And I'm sharing the results. We have 30% voted have an accounting, finance, or compliance background. 30% voted policy technical person, but generally understand the principles. 29% voted new to the federally funded program, and 11% voted at none of the above.
Okay, well that's a great mix. It's actually almost pretty much equal. And that's fine. We're going to try to hit the webinar to address the needs of all those different groups of folks. So we hope that, wherever you are, whether you're an accounting professional or whether you are new to all of this or somewhere in between, that you'll be able to get your questions answered. And again, there are lots of additional resources, and I'll also point you to some of the good written materials that it has as well as we go through this. All right, so let's go ahead and jump in then to categorization of the cost. So we're going to talk about 4 different ways or 4 different eligible types of costs that you might incur through your CDBG-DR program. And how you combine all of these and the amount of each of these that you have will be driven by the kind of program that you're running and the kinds of activities that you are funding. Key though, and we'll define each of these in just a moment, but the key thing to think about is at the very beginning of when you're beginning your program, and if you're in the middle of your program as you're going through it, is having a good sense of your overall budget and how you intend to allocate your costs by each of these categories. And the reason why that's important is because a number of these categories have maximum limits that you're allowed to spend for that particular type of cost. And so you want to have thought ahead about the kinds of things you're envisioning undertaking with your program. How might those costs be eligible? How am I going to have to categorize them? And am I likely to be closed or tight on my caps? And that'll be particularly true if you're administration cap that we'll talk about a little bit later. So let's define each of the 4 types of costs. The project costs are the kinds of things we typically think of when we're doing activities. They are the hard costs and the soft costs related to providing or delivering that project. So it's the construction materials, it is the soft costs, the engineering, the architecture, those sorts of things related to doing an activity. Activity delivery costs are the kinds of costs that are related to the agency, you guys as grantees, subrecipients, your costs to make that particular activity or project occur. And again, we'll get into some more detail in just a moment. Planning costs are related to overall community or state planning related to disaster response or related to disaster recovery, addressing new standards, new zoning, things like that. It's community-wide, it's large kind of planning for how to respond to your disaster. And then program administration costs are costs that are about how you overall administer and manage your CDBG-DR grant. And again, we'll get into more detail and examples of each of these. There are a number of really good resources, as I mentioned earlier, and you'll see at the back of this presentation some specific links to these materials. So if you do download the slides later, you'll get those links. But I want to particularly reference 3 materials, and there's 2 listed here, but there's a third that I also want to draw your attention to. So the first is 2 CFR 200. That is the new OMB regulation that consolidated, and we'll talk more about what that means in just a moment, some of the old circulars. There is HUD CPD Notice 13-07, which is a great notice that covers the distinction between admin and activity delivery costs, and it gives some really good examples and some nice charts that kind of help you to think about how to categorize your costs. And then one more that's not listed here that I want to encourage you to read, because I think it's also good, is SD 215-01, 2015-01, which is the notice that HUD put out about the new OMB circular consolidation. And it's got some good examples of how the circulars have changed and haven't changed, and the timing of the implementation of those new changes. Bottom line in all of this, and it'll pervade throughout all the rest of the section, OMB recently consolidated all of the old circulars. For those of us who have been working this a while, we used to have circulars A7, A110, Part 85, A133. Each of those were individual OMB circulars which dealt with particular aspects of financial management. In order to be more efficient and also to focus a little bit more on performance and outcomes, they consolidated all of those into one regulation, which is 2 CFR 200, and that's got all these sort of disparate sections are now all together. And so if you haven't become familiar with how that was changed and the timing of when those changes became effective, I do encourage you to look at 2015-01. That notice gives some good guidance on that. Basic rule, but there are some specifics that aren't quite, don't follow this exact rule, but the basic rule is that the effective date of all of that consolidation was December 26th of 2014 for new grants issued after that point, or additional funding issued after that point. So again, there are some caveats and changes to that for particular programs, and that's all called out in the HUD. Okay, so let's jump into the first category, which is direct project costs. So these are the costs, as I mentioned, where you provide subsidy to a beneficiary, and by that I mean a homeowner, a landlord, a business, a rental developer, and any of those kind of end beneficiaries who are going to use your assistance to create a project. And that project assistance might range from construction costs, the hard materials costs of construction. It might also include project soft costs, so it could include things like architecture, engineering, design work, all those sorts of things that a beneficiary has to incur in order to be able to do that project. So for example, if you give funds to a developer and that developer has to hire an architect to build the rental project that you're going to do or to plan for your rehabilitation, the cost of that architecture are project costs because they were incurred by the beneficiary and they're tied to the project. Similarly, things that we tend to think of as soft costs but are really considered direct or project costs in CDBG are things like developer fees. If you have a construction contractor and that construction contractor has overhead and profit in his project, those kinds of costs, those overheads, the fees and so forth, are again a part of the project cost. Similarly, if you are funding an entity, it could be a nonprofit, could be a subrecipient who is delivering a direct service. So you're going to pay that nonprofit to provide housing counseling, or you're going to pay that nonprofit to do some sort of other service for applicants. That public service, the cost of delivering that service are project costs. So all of those are eligible types of expenses, and again, they're all considered part of this direct project cost category. Now, it's possible, although more unlikely, but possible, that a grantee, meaning you guys or even a subrecipient, nonprofit or other public agency who gets funds from you, could have project costs. So let's take a very common example. Let's say that your water and sewer lines were completely damaged through your storm, and you're going to have to go rebuild new water sewer lines. And in order to be able to do that, you're going to have to acquire land, and then you're going to have to build the new water, have the construction costs to build a new water sewer line. And if you're going to directly do that as the grantee, and that's a little less common. Usually, again, as I said, it runs through some sort of partner. But if you're going to do it directly, and you're going to directly incur those costs, those could be project costs as well. For your cost to acquire the land, or your cost if you're going to have perhaps some sort of force account method where you're going to do the construction, those kinds of costs could be project costs as well. Now let's contrast that with activity costs. So activity delivery costs, one last point on project costs. There's no statutory cap on the amount of project costs that you can have as a proportion of your budget. And obviously this is for the majority of your money is going to go. Obviously you have to make sure it's cost reasonable and it's eligible and all of those things. But in terms of as a proportion of your budget, obviously you're going to see most of your money going through project costs. So activity delivery costs, on the other hand, are your costs as a grantee, or if you have a subrecipient who is administering that activity on your behalf, they are your costs to deliver that project or set of projects. So the only entities who are going to incur activity delivery costs are grantees or subrecipients. There's no such thing as activity delivery costs for developers or beneficiaries because their costs are project costs. So these are your costs and your subrecipients' costs to deliver a particular activity. Now let's stop for just one moment and define what it means when I say subrecipient for those guys who are new. So in CDBG, a subrecipient is a public or a nonprofit organization who administers an activity on behalf of the grantee. So you, the state, give money to a city, and that city runs a program on your behalf. or you, the city, give money to a nonprofit, and that nonprofit runs a program on behalf. So when we say subrecipient, that's what we're talking about. Again, it's a public or nonprofit entity running a program. So examples of the kinds of things that we mean when we say activity delivery costs. There are things typically about your staff that are the most common kind of activity delivery costs you have. So if you have staff or your subrecipient has staff who are doing things like your Davis-Bacon site inspections and reviews for labor standards, or your engineering and architecture that you are paying for. So if you, the grantee, are going to pay for an engineering assessment of a particular site, that would be a project delivery cost, activity delivery cost. If you are going to be doing the intake and the screening of the applicants, so if you're going to have folks come in, you're going to underwrite them, and you're going to screen them for eligibility, and you're going to figure out the amount of their assistance, the staff time to be able to do those reviews. If you have office space, where that office space is exclusive, and you can make a very clear distinction about that office space or those utilities, specifically for delivering a particular program or set of projects, that could be an activity delivery cost. Now notice I'm being fairly precise about this. Activity delivery costs and office space can be a challenge. If your office space is in the middle of your community development department, and you've got them sprinkled in and among other programs, your NSP program, your home program, your Section 8 program, whatever, and you can't clearly separate the costs which are associated with the CDBG program delivery or activity delivery, and by the way, those two words mean the same, program delivery, activity delivery, then you're not allowed to charge that as an activity delivery cost, because you have to be able to clearly segregate the cost in order to have it be active. So it's not enough to do some sort of proration. You can't say that I have 100 employees, and of those 50 actually work on CDBG, so therefore 50% of my my leasing costs, my office-based costs. You're not allowed to do something like that as activity delivery. It has to be clearly severable. So in other words, it's a separate building. Or if you know the specific cost of a particular floor, the entirety of that floor is delivering a particular program or project, that might be okay. So you may be able to charge office space, but you have to be able to sort of do the segregation. If you can't do that, and it's not easy to separate, and you can't clearly show the exact cost of that space, then we'll talk about that as part of administration or an indirect cost in a few moments. In CDBG-DR particularly, it's also quite common to have activity delivery costs or program delivery costs which are undertaken by a contractor. And so oftentimes, because of the scaling up that's necessary to address the disaster response, what we see are grantees who are contracting out for some services. So typically, things like application intake. So if you hire a firm to procure them, and you hire them to work on your behalf, taking in those applications, doing your underwriting, and so forth, even though that's a cost incurred by a private contractor, it's a contractor to the grantee, and it is doing that service in your stead or on your behalf. And that could be an activity delivery cost, the cost of the grant. That would also be true of things like environmental reviews. We've seen some grantees contract out for the data collection around, again, doing the job on behalf of the grant. So those are the kinds of costs that are contracted, but could be activity delivery because, again, they're costs. Okay, so the cap. There is no cap on activity delivery costs. So there's, you may have heard some people say 30, 20, 10, whatever percent. There is no specified particular cap on the percentage of your cost, of your total budget or your total project cost that can be activity delivery. That said, however, as with all things in CDBG, those costs have to be reasonable and comply with those cost principles that we talked about earlier, the OMB circular at Part 200. So we're going to have to document that whatever we pay for is, of course, eligible and reasonable and necessary and all of those things. What is eligible and reasonable and necessary is going to vary by the complexity of the activity you are administering. And again, remember I said these costs have to be tied directly back to delivering that particular activity. So we have to have a connection between the activity delivery cost and the program or project which I am helping to create. And so in thinking about a reasonable level of activity delivery cost, we need to look at the complexity of the project and, again, cost reasonable, and think about what proportion would make sense. And so the more complex of a project with lots of moving parts, or program with lots of different kinds of applicants we have to review and so forth, you might expect to see a higher percentage of activity delivery costs than a program which is relatively simple, has been done before, and doesn't require a lot of complex staff interaction. So, there's no hard and fast rule here, but there are, you have to think about sort of what's reasonable given the kind of activity that I am doing. Now, whenever we're doing activity delivery costs, whether it's us or whether it's the subrecipient, we always have to be able to back up that cost, just like any other cost we're going to charge. This is particularly difficult for activity delivery costs because, again, as I said, most of those costs are the staff who are working to create projects or to create programs. It's mostly time that we're talking about. And so in order to back up that cost, we're going to have timesheets. And that's true for every single person who we're charging to activity delivery costs, not only at the grantee, but also at our subrecipient. And it's not enough, and we've actually had folks in the most recent rounds of funding who've had monitoring findings on this issue. It's not enough just to say that they worked on CDBG. Because again, as I said, activity delivery is about delivering that program or project. And so we have to be able to break out the cost by that activity. So it's by that program, by that type of project that I am funding. And so if the staff are working on your homeowner rehab program, their time should indicate the part of their time that did that. And if they also work on your economic development program, it should indicate that. So we need to have timesheets that are broken out by activity type. One thing that we've seen a lot of questions around is, well, what if I have other funding sources? Maybe I have state funds, maybe I have other federal funds who are paying for the hard costs of construction, but I want to use my CDBG-DR staff in order to be able to help them to deliver that activity. You can do that if it's eligible under CDBG. If the underlying activity is eligible, you could pay for the activity delivery cost. But what you have just done is invested CDBG money in the project by having the staff work to deliver it. You basically made the project itself CDBG. So therefore, the underlying project has to meet all the CDBG rules, and that would include not only the DR rules, but all the other federal rules that come with. So David Bacon, environmental, all the things that we bring with our. So be very cautious about paying activity delivery costs if you're not also funding the underlying. As I mentioned, activity delivery costs are considered tied to the particular project or program that you are delivering, and so all the rules come with that, and those rules include the national objective and the 50% low mod targeting requirement. And so the way that we count that, because again, this is primarily staff costs we're talking about, is that those activity delivery costs are considered to meet those rules in the same proportion as the underlying program or project. So if my underlying program had 60% LMI targeting, then 60% of my activity delivery costs would be considered to meet low mod targeting. Again, we've talked about the citations under the OMB circulars. There is also some sections of the CDBG regulations at Part 570, which also gives you additional guidance. All right, so the next category of costs is planning costs. And this is something that actually is a little bit confusing because we could have project plans and we could have community or other kinds of longer term plans. When we say planning in CDBG, we mean those longer, broader types of planning activities. So it's not a specific project. You're not planning the feasibility or the analysis of a particular project, because that would be a project cost. But rather we're talking about an activity whose end result is some sort of community or state plan, and in our case, for this purpose, is related to recovery. And again, it could have to do with, maybe FEMA has put in new flood maps and you have to address it. Maybe the community wants to change its zoning requirements for the rebuilding to make it more resilient. Maybe you want to think about new mapping to figure out where you want to rebuild so that you're more resilient in the future. All those kinds of planning activities at the community level would be a planning type of cost. Again, planning activities are only undertaken by grantees and subrecipients. So we don't have private entities undertaking planning costs in the context. Again, we might have private planners on projects, and that would be a project. But in terms of the kinds of end result planning activities, these are grantee and subrecipient costs. And again, it can be anything from gathering the data on the plan to writing the plan to public input on that plan, anything that's sort of related to that community planning output. There is a cap on planning. That cap is 20%, but that 20% cap is in 20% of your grant and program income. That 20% is inclusive of your administration. And so it's 20% planning and admin. And as you'll hear in just a few moments, in most but not all disasters, your admin is capped at 5%. So if you spend the full 5% on administration, that only leaves you 15% for your plan, is a way to think about it. And again, the sum of all of those, no more than 20% of your grant award plus any program income that you earn. And we'll define program income in just a few minutes. Now, if you're a state and you're listening in, and I know we do have some state grantees who are with us, you'll know this is actually different than your normal CDBG program. So normally when you run the non-disaster recovery CDBG program, planning is an end result as a planning-only grant. And because it's a project, the planning grant is considered a project, that planning grant actually has to eventually meet a national objective. And so it's actually treated as if it were a project. For the purposes of DR, that's been waived for most recent disasters. Now, again, you're going to want to look at your particular Federal Register notice to be sure this is true for yours. But in general, that typically gets waived, and the state is allowed to act as entitlement to and fund planning-only grants where the end result is a plan and where the activity does not have to meet an act. Okay, so our last category of costs are program administrative costs. And these are the kinds of costs that your organization, again, your grantee or your subrecipient, is going to incur in order to manage the CDBG-DR program. So it's not the general management of the city, it's not the mayor and that kind of thing. Those are not going to be eligible program administration costs. And it's not the delivery of a project or program, because those are activity delivery costs. This is the management of the part of the organization who is overall overseeing your CDBG-DR grant award. So we're talking about things like the people who monitor the compliance with your grant, the people who do your periodic reporting and the cost of the net reporting, and who enter your data into DR, the financial tracking system. We're talking about folks who do your human resources and your accounting support for the delivery of your CDBG-DR program. We might also be talking about that office space. So I mentioned earlier that if we really cannot very clearly separate, it might be an eligible admin expense, although again, we still have to be able to separate in general now which costs are related to CDBG. So it might not be for a particular program, for just my homeowner program, but it would at least be able to say, this is the part of my office space which is particular to my CDBG-DR program. And again, utilities will follow the same law. One point here I want to make sure we make a key point about is the monitoring activities that you do. So when you monitor your subrecipients, when you do your long-term monitoring, like after you have had an activity is completed, but if you're still tracking jobs, if you're still tracking the housing affordability period, those kinds of long-term activities, all those sorts of things are the staff costs related to those or admin costs. They would all be under here. Now, one key question we get a lot is, well, could I use my CDBG-DR admin to help subsidize other recovery programs? Like maybe you're not getting enough admin from the FEMA funds or from funding you got from EPA. Unfortunately, the answer is no. You are only allowed to use CDBG-DR admin to administer the CDBG-DR activity. Okay, so as I mentioned earlier, we do have a cap. The cap on CDBG-DR admin is 5% of your total grant award and 5% of your program income. And again, as I mentioned earlier, the only people who can partake of that 5% pot are the grantee or any subrecipient. Now the question is, who gets to decide how the 5% gets divvied up? So it's 5% in total. So the answer is the grantee. And so when the grantee decides if it wants to work for a subrecipient, be that subrecipient a unit of local government or a nonprofit, or maybe even some state authority that's a separate legal entity, the grantee has to decide how much of its 5% is willing to share with that entity. And so that's negotiated depending on the complexity and the difficulty of the program that's being run by that subrecipient. And again, the grantee is responsible, but in aggregate, when all those expenses are all added together, both its and its subrecipient, the total does not exceed 5%. That will be called out in the grant agreement between the subrecipient and the grant. All right, so let's do one more poll, and then we'll take some questions, Chantel.
Okay, so for our second poll, which of the following expenses would be an eligible activity delivery cost? We have here staff costs to develop an action plan amendment related to a new housing program, or the cost for a contracted entity which accepts and underwrites the DR economic development applications, grantee who runs a CDBG-DR clearance program, rent for all of the office space occupied by the DR division, or is it funds paid to a developer related to the design of the DR-funded rental project? The polls are now open.
And a hint, guys, there's a couple of these that you may have some questions about, and we'll talk them all through. Some of them are a little bit on the fence, and that was there on purpose so we could talk it through. And again, if you're with a group of your colleagues, feel free to debate them as you vote. All right, Chantel, so how are we doing on the voting?
We have a little bit under 40% voted so far.
Okay, so let's take one last moment. If you haven't had a chance to vote, just take a guess. Okay, so Chantel, let's go ahead and poll.
Okay, and I'm sharing the results. We have 27 voted the staff cost to develop an action plan. 20% voted cost for a contracted entity which accepts and underwrites DR economic development applications. 15% voted grantee runs a DR clearance program. 19% voted the rent for all office space occupied by the DR division, and 19% voted funds paid to a developer related to the design of a DR-funded rental project.
Okay, so let's go through all of these, because that's interesting that we had a dispersion of the votes across all those. So what we're asking for here is, which of the following will be an eligible activity delivery cost? So remember, those are costs which are incurred by the grantee or a subrecipient, and they're typically your staff costs and related costs for you to deliver a program or project. So with that definition in mind, let's go through each of these. So let's start with the first one. So the staff cost to develop an action plan amendment. So let's ask the question, is that related to a specific program or project? That would be no, right? The action plan is going to be related to the administration of your overall program. So yes, we're doing an amendment for a housing program, but the action plan is about how you overall administer your activity, how you administer your funds. And so the costs related to developing action plan amendments are admin costs. They are not activity delivery. So that first one would not be activity delivery, it would be admin. The second one, the cost for a contracted entity which underwrites a CDBG-DR economic development program application. So is that activity related to delivering a specific project program? Yes, it is, right? It's related to your economic development program. And is it being undertaken by the grantee or a subrecipient or on their behalf? And the answer, of course, is yes, right? We have a contracted entity working for the grantee who is doing the underwriting on their behalf. So that second one would be an eligible activity delivery cost. The third one is a clearance program. We're here, and this one is one that's kind of in the middle. So the grantee is going to fund a clearance program where the grantee is going to directly demolish dilapidated homes. The grantee is going to go out, it's going to take its own funds, probably have to acquire those houses and then tear them down. So that one would actually typically be a project cost. It could be activity delivery, like I said, you could go either way in that one, and it probably wouldn't make any difference because they would be eligible either way, but probably would be a project cost, but you could go either way. The rent for all office space, and here's the key here, all office space occupied by the CDBG-DR division. Remember I said that if you're doing activity delivery, you have to tie it back to a particular program or project. So is CDBG-DR division a particular program or project? Probably not. And so the office space for the entire division is probably more likely an admin cost if we can separate those costs and not have it interspersed with our other kinds of things that we do that are not DR. But typically that's an admin. And the last one, funds paid to a developer to design a CDBG-DR funded rent project. So again, remember the key on activity delivery is it's a cost undertaken by the subrecipient or the grantee. So a developer would not be a subrecipient, right? A developer is the entity which is undertaking the construction activity. It's not someone who's managing a program on your behalf. And so that would actually be a project cost, not an activity delivery cost. All right, good. So let's start taking some questions.
Sure. So we have 3 questions right now.
Okay.
The first one is, how do we handle activity delivery costs, for example, for intake or determination of eligibility of an applicant that turns out to not be eligible? Would that be considered activity delivery costs, or does the cost have to be moved to administration?
That's a great question, and we're actually going to cover that question in a little bit, but I'll give the quick answer now, and then we're going to dive a little more deeply into when we talk about eligible costs in a few minutes. But the answer is, initially, it can be considered an activity delivery cost. So as I mentioned earlier, screening of applications and underwriting of those applications is an eligible activity delivery cost if you've got a timesheet and you've tied it back to that particular program. However, unless the program is housing rehab, so I'm going to come back and talk about housing rehab in just a moment. Unless the program is housing rehab, what the HUD guidance says is, if that activity does not go to fruition, if you do not complete the activity and meet a national objective at the end, then the staff costs, those activity delivery costs, for that incomplete application do have to be moved over to administration. So you have to be able to, that's why it's important to have those timesheets that back out what people were working on, because you are required to then back out that cost out of activity delivery and move it into admin. And if you have too much of that happening, obviously that's going to count against your admin cap. So it's important to have a handle on that. Now, as I mentioned, there's a slight difference for homeowner rehabilitation, for housing, I should say housing rehabilitation. And that housing rehabilitation difference is, in CDBG, there is a quirk of the way that the statute works that allows for housing rehabilitation to be set up as an activity delivery, to be set up as an activity unto itself. And so for housing rehabilitation only, you are allowed to leave that cost in activity delivery, and even if the house does not go to fruition and does not get constructed and meet a national objective. Housing rehab only, you're allowed to leave it in activity delivery. That's again why the timesheet is important, to prove that it was housing rehabilitation time. Again, my suggestion to you, if you get yourself in this situation, is to have a conversation with your HUD field office. I will tell you honestly that there have been times where there's been additional flexibility given the situation, given the particulars of the circumstance. So I would encourage you, you're starting to see a lot of time spent having to get moved over to admin. You want to have a conversation with your HUD rep about that and figure out kind of how to approach it. The other thing to be careful about is, again, as I said, if you move it over to admin, it counts against the admin cap. And if you start to see a lot of that being backed up, where you're beginning to eat up a lot of your cap, you may end up having to pay some of it back actually with non-federal funds, because again, you're going to finish out your cap. So again, if you're starting to see a lot of that happening, have a conversation with your HUD rep and work together to see how to proceed. Okay, next one, Brandy.
Okay. Yeah, we have two questions that are kind of related. It's about soft costs, such as studies and designs, and asking for clarification as to when and whether they could be considered activity delivery costs or whether they're always admin.
Okay, so if the costs are for project-specific kinds of studies, right, so the feasibility of a particular site, or if it's a rental project and you're trying to figure out what the market for that project is, or if an engineering assessment, you're going to figure out how much you have to elevate it, or any of those kinds of things like that, where you can tie that cost, that study or that engineering or whatever it is cost, to a particular program or a particular project, then you can call it an activity delivery cost, not an admin expense. Again, assuming that cost is being undertaken by a grantee or a subrecipient, I mean, that's who's incurring the cost. Again, if that project doesn't go to fruition, and assuming it wasn't housing rehab, you've got the same issue that we just talked about. If that cost is being undertaken by a developer, right, so it's a developer who's going to pay for the study, the engineering, whatever it is, that's a project cost. And that can be an eligible project expense, not activity delivery. Remember, developers never have activity delivery. project. The issue there gets at the timing that I think Brandy was hinting at, which is when is it eligible? And the reason why that's important is because we have the disaster that occurs, get your funding from HUD, don't yet have your grant agreement. You have folks who are trying to recover. They may be very well doing some of that architecture and engineering now in advance of having had a grant award from you. So those are called pre-award costs. And sometimes those are allowed. It depends entirely upon your particular disaster and what HUD has waived. And the reason why some of those can be a challenge has to do with the environmental review that has been. So what I would encourage you to do is, if you have a developer who wants to incur pre-award costs, again, watch the Federal Register notice. It will clarify how this is going to apply for your particular disaster. If you want to see kind of what's been done in the past, look at the Sandy notices that came out for 113, 113-2 is the Sandy appropriation. You'll see how HUD handled this very issue. Again, no guarantee that yours will be handled the same way, but at least it's a good direction to go. And if you're still stuck in that boat, have a conversation with your HUD rep while you're waiting for this guidance to come out from HUD about how to handle it. So pre-award costs can be a little bit tricky for developers. If we're post-award and you've already got an agreement with that developer, then those kinds of costs are an eligible project cost. Next one, Brandy?
Yep, and the final one for the moment is related to, I think, what we just went over in the poll. If a grantee pays a procured consultant to write their disaster recovery action plan, can that also count towards the 15% planning cost?
Okay, so if you have someone doing your action plan and they are doing it procured for you, can you count that toward planning and admin rather than, I guess, project cost or something? Yes. So it doesn't matter whether the planning is being undertaken by the grantee or whether you've contracted with someone to do your action plan amendment for you. That can be considered an eligible planning and admin expense, and actually technically it would be a planning expense, part of the 20% planning and admin.
Okay, that's it for now. That's it for now.
But folks, do you want to weigh in on those? That's folks anything to add? Okay, well, hearing none, I'm going to keep going then. All right, so we're going to next move on to indirect and direct costs, which do get confusing when compared to admin costs particularly. So we're going to try to make a distinction in what we mean here. So if you go back and you look at the OMB circulars, you'll see that the circulars clearly call out two big types of costs. And there are lots of subsidiary sections, and we've been talking about those sections as we've been going. But two big types of costs in the federal world. There are direct costs and there are indirect costs. So direct costs are costs which you can attribute to a particular, they say cost objective, but in our world that would be a particular program. So by that we mean CDBG-DR. So can you attribute that specific cost to some element of your CDBG-DR program? So it's specific to your housing programs or your economic development programs or infrastructure programs, whatever it might be. You can directly attribute that cost back to one or more of your CDBG-DR eligible activities. So in this case, we're not specifically trying to get down to a particular project or even a particular program type. What we're saying is that cost we can directly associate with CDBG. Okay? So it's not serving more than CDBG. It's not serving CDBG plus FEMA or CDBG plus all of your housing programs or whatever it might be. It is specifically attributable to CDBG-DR. And how you're going to know that will be based upon the documentation, right? So we talked about the billing, we talked about the backup documentation, and so forth. You're able to document that particular cost directly and solely related to it. Contrast that with indirect costs. So indirect costs are costs which are typically cutting across multiple programs or multiple types of endeavors that the grantee is doing. So it benefits more than one objective. So think of costs like shared janitorial service. So if you have, let's take a city, and that city has one janitorial contract, and that janitorial contract services every city agency, so the Parks Department, and the Human Services Department, and the CDC. So everybody gets the same, janitorial service. Or maybe everybody has shared human resources department in the city, whose job it is to do all the hiring, firing, all that kind of stuff across every city. So you can see that it's a cost which cuts across different types of programs, it cuts across different types of activities, from cost centers and so forth. And the city is providing a service, or the state as well, is providing a service across all of those various programs or various activity types. So you are getting a benefit. You're getting that janitorial service. You're getting that human resources service. And it benefits your CDBG-DR program, but it's not solely and uniquely attributable to shared. Those are called indirect. And so if your city or your state wants to be able to have CDBG pay for a part of that, pay for its fair share, if you will, of the indirect cost, then you have to do what's called an indirect cost allocation plan. And the idea behind an indirect cost allocation plan is that you have an accounting professional, often a CPA, but another professional, who tallies up all of those indirect costs and figures out, based upon that analysis, what the percentage is, the proportion, which is shared across everybody. So everybody kind of gets a tax, if you want to think about it that way, that their program pays to cover their share of those shared direct costs. And so that indirect plan we'll talk about in a moment, but until you've got an approved indirect plan, you're not allowed to charge indirect costs back. So if you want to do this and you don't have an approved indirect plan and you do have indirect shared by the cost, you're going to have to go through the exercise of putting together an indirect cost allocation. Now, one of the things that people, as I said, get confused about is they mix up indirect and admin. So they sound the same. They're both kind of those sort of overhead kinds of expenses. But the distinction is, even with admin and CDBG, you have to be able to directly attribute it back to administering or managing your CDBG funds. It's directly attributable to the direct cost. Indirect costs are things which, as I said, are kinds of share. Now, one of the things we've had a lot of questions about in the past is, so if I do get an approved indirect cost allocation plan, does that somehow raise my admin budget? Right? We said admin was 5% of your grant award and program income, and the answer is no. So if you want to be able to pay for your indirect costs, then, and assuming that those indirect costs are typically admin kinds of expenses, although they could be projects, but typically they're admin. And if you're going to charge it back to your admin, that proportion back to your admin budget, that has to fit within your 5% admin allocation. It does not raise 5% by any means. So what we've had happen, particularly for smaller grantees, is the larger your indirect cost allocation, your indirect portion of your budget that you're covering, the less you have left to pay for admin. And it can really eat up your admin budget. So you need to be careful to think about how you're going to do that if you're going to. Okay, so if you're going to do a cost allocation plan, as I mentioned, you do have to have it approved. It goes into your federal cognizant agency. So it depends upon who does your audit reviews and so forth for your agency. If you don't know who that is, your financial people probably do. If you're a nonprofit and you haven't ever heard of that, talk to the folks who are your grantee. They can probably help you through it, or the HUD field office can help you through it to figure out who your cognizant agency is. Usually, but not always, it's the federal agency who gives you the most amount of money. So you might have HHS, you might have EPA, you might have HUD, it could be any of that number of agencies. So again, talk to your HUD rep to help you figure that out. As I said, your plan has to be based upon the legitimate cost which CDBG benefits from. So you can't just have a shared service, like back to my janitorial service concept. If that janitorial service doesn't actually service the CDBG agency, then we shouldn't be paying. So it has to be tied to things which we are actually going to pay for. However, we also have to be careful that we don't double. If an expense is covered by an indirect cost rate, and we're going to go ahead and bill that rate back to CDBG, then we can't also pay for that same type of cost as an admin expense. So if I'm going to pay for those janitorial services as an indirect cost allocation item, then I can't also pay for the very same janitorial services as an admin. So you have to be quite careful that once you've decided to do this, to know whether that cost is covered by your indirect plan or whether that cost is covered by your admin plan. All right, so let's do our third poll.
Okay, so for our third poll, which of the following costs could not be covered by an indirect cost allocation plan? a consolidated personnel agency that does hiring, HR for all state departments, or lead-based paint inspections only for DR projects. Another option we have is office space located in City Hall, subrecipient costs for shared printers, copiers, office supplies, or is it basic office supplies purchased for the entire agency and distributed to individual departments?
So again, some of these are kind of tricky, so we'll talk through them. Take your best guess on which ones would not be part of an indirect cost allocation plan.
About 30% of our participants have voted.
Okay, we'll give you just one more minute. Again, take your best guess, and we'll talk them through. Okay, Chantel, how are we doing on the voting?
We have about 58%.
Okay, so let's go ahead and walk through them.
Okay, and I'm sharing the results now. We have 9% voted with the Consolidated Personnel Agency. 55% voted lead-based paint inspections only for the DR projects. 15% voted the office space located within City Hall. 9% voted the subrecipient costs for shared printers and copiers. And 13% voted basic office supplies purchased for the whole agency.
Okay, great. So let's go through all of them. So the first one, and again, you're looking at which ones would not be part of an indirect cost allocation plan. So the first one is the consolidated personnel folks that does the hiring across everybody in the state, all the state agencies. So that's the kind of thing that would typically be in an indirect cost plan because it's a shared cost across everybody. Now, your personnel agency could handle it differently, and it's possible that they have specific people who just work on the CDBG program, and so maybe that's an admin expense if you handled it that way. But if they're all kind of shared across everybody in the whole state, and therefore you want everybody to pay for a part of the cost of the personnel HR agency, then yes, that could be a part of a cost allocation, an indirect cost allocation plan. Looks like most of you got the next one right, that lead-based paint. So lead-based paint inspections would not be part of a cost allocation plan, an indirect cost plan, because those are specific. They're either a activity delivery cost, if those inspections are undertaken by the grantee or the subrecipient, because again, they're specific to a CDBG project, right? So they're a direct cost. Or perhaps they could actually be a project cost if they're undertaken by the developer as part of his rehabilitation of the project. But they would not be an activity, they would not be an indirect cost. Office space located in City Hall could possibly be an indirect cost. Again, it depends upon whether you're able to sever those costs. And if you knew that the CDBG-DR agency is one particular wing of City Hall and you know just what that costs, or you know the particular floor and how much that costs, perhaps that's all attributable to CDBG admin. But assuming it's just all part and parcel of what City Hall costs and you're going to pay for your share of City Hall, then that could be an indirect cost allocation item. The next two are definitely ones that could be indirect cost allocation items. The subrecipient costs for shared equipment, again, shared across activities, everybody uses the same printer, so that could be an indirect cost. And again, office supplies, where we're buying them in bulk from Staples, let's say, and we're going to just parcel out the pencils as people need them, again, that would be a common type of indirect cost. All of those sorts of things that we just said could be indirect costs, with the exception of the lead-based paint, which would not be, would have to be part of that indirect cost analysis and then the planning. All right, so with that, Brandy, do we have any other questions?
Nope, none right now.
Okay, all right, then let's go ahead and move on to documentation, and we'll have another chance to take some questions as we go. Okay, so I think people get the general idea behind the 4 eligible types of CDBG costs, and then the sort of overlay from OMB, which is direct and indirect costs, as a sort of categorization of those costs. But now we have to look at how do we prove that that type of cost I incurred was in fact eligible, and that is obviously through documentation. And the federal grants, we're going to have documentation. I think the place where people typically get in trouble with documentation is around those personnel costs. People generally understand that if I'm paying for a good or service, I have to have an invoice or a bill or a contract to back up that expense. But it's the personnel where we have people working every day and doing a lot of different things where it can get confusing. And so as we mentioned earlier, to back up those personnel costs, and again, whether they are staff of the grantee or staff of a subrecipient, if they're going to bill back the personnel costs as either activity delivery or as admin, all that needs a timesheet. And that timesheet has to indicate the particular activity type or the admin, if it's admin, that the person is actually working on. And it can be a mix, right? So we can have staff who spend a third of their time on their homeowner program and a third of their time on your economic development program, and the last third of their time helping you on your admin or your planning. And it's fine to allocate someone's time that way as long as we have a timesheet to back up how we allocate their salary. So we have to have a timesheet or time card or any kind of timekeeping system which backs that up, which backs up the cost that the staff member is incurring, time that they are incurring by program parent, so that we know how to attribute that activity delivery cost to the particular program or to admin if that were applicable. We also do have to have payroll to back that up. So it's not enough to have a time card or a timesheet for Susan and for her however many hours she said that she worked. We have to back up what salary we paid Susan. And that salary that we paid her is backed up by your payroll record. And that payroll, we then have to show how we took Susan's salary using her timesheet, and we divided her salary by the applicable programs that she worked on if we're doing activity delivery, or admin if that's the case, and show how her salary got distributed based upon her timesheet. So the two things work together. As I mentioned earlier, we also have to back up for all the other things that we might buy, right? So every single thing we're going to spend money on in CDBG-DR needs some type of backup. We're talking about invoices, we're talking about agreements or contracts if we're contracting for a service. We have to have a backup documentation of what it is that we have to spend money for every single expense that we spend. We will have to also prove that those expenses were cost reasonable, and we'll talk about that in a few minutes. As I mentioned earlier on salary, again, we have to have the salary, and we have this in here twice because it really has been unfortunately, it's been an area of a lot of auditing findings. So we do have to make sure that we've got that backed up by timesheet, and that then ties out to payroll. There is a process for the administrative and financial staff of the grantee to actually certify the veracity of what they have done, and you're required to do that certification periodically. I believe that certification is done at a minimum annually or semi-annually, but it would be, many people do it more frequently. All right, so we get now to the question that we had earlier, and I want to recap the answer because it is, unfortunately, a very complex part of CDBG. So the question we had earlier, which was about incomplete projects. So I put money into a project or into activity delivery. I have a staff person who is doing the screening of applications, and let's take it out of housing rehab for now, and let's focus on economic development today. But it would be true of anything that's not housing. And I have those applications coming in, and I'm screening them for whether they have a tie to the storm, and their DOB, and duplication of benefits, and their underwriting, and how much need they have, and all those things that I have to do before I'm allowed to fund them. And as going through that process, I determine they are ineligible, or they decide to drop out. They don't want the assistance, or whatever, or they get their needs met somewhere else. So that application, the cost, the time involved in screening that application, unfortunately, because it did not, in the end, meet a national objective, needs to actually get moved over. That time needs, the cost of that time needs to get moved over to admin and not remain in activity delivery because it didn't result in an activity which eventually met a national objective. So in order to be able to do this, again, for everything but housing rehab, you're going to have a process for tracking what ends up happening to your applicants and moving over the associated costs over to your admin budget. Now, again, as I said, in the past, in the real world, there has been some flexibility here, and I would encourage you to talk to your HUD rep about how they think you should handle this and how they're going to when they come out to look at you and they come out to monitor this question, how it is what they're going to be looking for, and work out an arrangement between you and your HUD representative about how to approach this issue. Because you can imagine that, this can get pretty detailed and pretty consuming from the burdensome of having to do all these costs back and forth. So have a conversation with your HUD rep about this. The exception, as I mentioned, is for housing rehab. The statute just happens to be set up that way, that for housing rehab and housing rehab only, you are allowed to leave those costs in activity delivery, not have to see if that has to have activity, that particular activity cannot proceed. Now, I will tell you that there have been grantees that kind of took advantage of that and ended up having a very small percentage of their applicants actually going through to getting rehabilitation and getting completed, and ended up having most of their costs for ineligible applications that never proceed. And when you get into sort of out of whack like that, it actually can be a monitoring finding that the procedures and your intake isn't as efficient and effective as it could. So, you know, obviously you want to be monitoring and have a sense of what proportion of your application is actually going. A related concept, but not the same thing, is what happens when we have ineligible costs. So rather than a project that just, for whatever reason, the project did not proceed or did not get to completion, here we have something where the money was spent, but it was spent on something ineligible. So we gave money to someone for homeowner rehab, let's say, and we thought they were going to use it to repair their roof, but in fact they used it to buy all top-end appliances and put in a jacuzzi. So those are ineligible items that we don't pay for. So when we have an ineligible expense, there we don't get the opportunity to move it as. When it's an ineligible expense, we actually have to pay that money back to our HUD line of credit or to our treasury account out of non-federal funds. We can't use CDBG to pay for that. So what really happens in that instance is you would enforce your grant agreement with a homeowner, in my example. They would repay you, you would repay HUD, but it would have to be repaid out of non-federal funds. Finally, in addition to documenting eligibility, you have to make sure that for every one of these expenses, as part of documenting your project, that you have documented the connection back to the disaster which you are addressing. So whether it's planning expense or project expense or whatever, we always have to be making sure that we've documented that it is tied back to disaster recovery CDBG. Okay, any questions yet, Brandy?
Yes, we have two questions. One is, if a project is awarded to a subrecipient, and then the applicant to that subrecipient hires a grant administrator to handle everything for that specific project, would that be considered an activity delivery cost since it's specific to that project?
Good question. So we have a grantee who hires a subrecipient. The subrecipient hires, and I assume they mean staff, but I guess it could be contracted. It probably doesn't make sense. But they hire someone to administer a particular CDBG eligible activity that they are going to be doing on behalf of the grantee. So if what that person is doing, if the job description of that person and what they end up doing is directly related to projects, directly related to working with applicants, directly related to activities, then yes, that's an activity delivery cost for the subrecipient. If, however, what that person is doing is also planning for the program and reporting to the grantee and doing financial management and all of that, then that might be an admin. So it depends upon the nature of what the job is. If what that person is exclusively doing is related to delivery of that program or activity, then that would be an activity delivery cost. And they'd have to document the timesheet and all the stuff we've already talked about.
And then the second question was related to how does the grantee document that their planning activities actually tie back to the qualifying disaster event? Okay, good question. So the grantee wants to do a planning-only activity, again, within that 20% cap, and we talked about the planning having to have at least some connection back to the storm. So I think, in my mind, it would depend upon what you're planning for. So to be frank, I think it's probably pretty easy for most planning activities to have a good tie back to the storm, because it's mostly the reason why you're planning is about, helping the community to grow, helping the community to recover, and so forth from the storm. So I think I'd want to document the nature of what the planning activity is what I'm funding. So am I funding, for example, something about new housing standards? And if that were about new housing standards, I could document in my files that that's related to rebuilding in a way that is that would be documentation. I think you just want to be able to look at the nature of the kind of plan that you are funding and say, how does the nature of the kind of that plan help us to recover from our designated disaster or our event? Really, I think the only kinds of plans that you might have a hard time with are, things where, let's say, all of your disaster, everything that happened is all entirely to your infrastructure. I can't imagine this, but it could have happened, I suppose, that all your damage happened to infrastructure, and yet you're doing a housing plan that has nothing to do with infrastructure.
That kind of thing might be hard to make a connection with. But generally speaking, I think it should be pretty easy to say what is the nexus between why I'm bothering to pay for this plan and how it then helps the community fulfill. And ask yourself that question, and I think in most cases you should be able to connect and document that. Any more, Brandy?
No, that's it for now.
Okay, and HUD folks, do you want to jump in on any of those questions? Okay.
Nope, you're doing great.
We're going to move on to cost principles. So this is tying back to those OMB circulars that I mentioned earlier that is now in 2 CFR Part 200 that was consolidated. And for those of us who've done this for a long time, that's the old A87 requirements, which deal with sort of how we have to actually be approaching cost documentation and cost eligibility. And those cost principles in Part 200 call out 4 basic things that any federal cost, so that now we're no longer in just CDBG world, we're actually in any kind of federal grant that you're working on, but we'll apply it in a CDBG context. Any federal cost, any federally paid cost has to be necessary, reasonable, allowable, and allocable. So we're going to go through each one of those. So let's first talk about necessary, and this is one that particularly comes up as a question in CDBG-DR. And so what we're saying when it's necessary is, remember, federal funding is supposed to be the funding of last, right? That you have tapped out all of your other resources that's available to you, and we are filling a funding gap. That you need the federal assistance in order to address that gap in your funding. And so need is obviously a little bit squishy, and so how do we figure out what that means? Well, you want to document things like, is this cost necessary to complete this recovery action? Right, so we're going to do rehabilitation. We could show the budget for the rehabilitation and show all those other sources, and oh, there's a gap, and therefore we have to help fill that gap. That would be an example. In order to be able to undertake the rehabilitation of this community or revitalization of the community, we need to be able to rebuild their sidewalks. So we need to be able to help them repair the broken street lights. We want to ask ourselves the question: how is this expense that I'm trying to pay for necessary in order for the recipient to be able to recover from the storm? And if you document that, however that is, and again, typically it'll be some sort of cost analysis, that'll help. Now, one of the things that we've seen that comes up is disaster recovery gets longer into its life cycle, because the nature of disaster recovery is that you never really finish it in a matter of the first couple of months. It tends to take quite a few months, if not years, to be able to get through the process. And the longer you get away from the storm, the more likely it is the entity, the beneficiary, has recovered on their own. And so you want to ask a question about, do they still need this assistance? And this comes up particularly in economic development projects, where you might have a business that comes into you and says, I would like working capital assistance. Perfectly eligible, but do they still need the working capital assistance? Have they actually, maybe they needed it a year after the storm, but now it's 3 years later. Do they still need our assistance in order to get back on their feet? Or are they, in fact, already back on their feet and no longer need our help? So that kind of a financial analysis, say, do they still today need our assistance? And that can be tied to the underwriting. And whether it's rental housing underwriting or whether it's economic development underwriting, cost analysis for other types of projects, you want to do some sort of analysis to prove that there is, in fact, a gap, and that gap is reasonable, and that we need to be the ones filling the gap. Which leads us to cost reasonableness. So this is slightly different than necessity, and this is basically saying, is the amount that I am paying for the eligible item what a reasonable person would pay for that similar item? So this is no longer about, is it eligible or not, is it needed or not. It's, is the amount that I am paying for it at a reasonable cost to pay for that item or set of items? And cost reasonableness pervades everything you pay. So everything you're going to spend money on in CDBG needs a cost reasonableness document. And sometimes you can group them together and do it in a cluster, but you still need to have an analysis of, before I pay that expense, is this a reasonable amount paid for that expense? So how do you really do that? Well, you're going to look at what comparable market prices for a similar cost item, what would that cost? What is typical, reasonable, necessary, appropriate to pay for that particular cost item? One of the ways that people do this as part of procurement is to look called an independent cost estimate. And this is a requirement for whenever you have to procure items. And so what that says is, prior to putting out your RFP or your invitation for bids or whatever you call it, you need to do an in-house cost estimate to say, given the scope of work that I am procuring, how much do I think this ought to cost? And that in-house cost estimate is often done by an engineer or an architect or a planner or someone who knows something about what these items typically cost. Sometimes it's also done by contractor. You could hire out for someone to do that cost estimate for you. But there have been monitoring findings for grantees when they have failed to do an in-house cost estimate prior to issuing. So do an in-house cost estimate. That gives you the range of what you expect bids to come back at from your RFP. Do your RFP, and then compare the bids that come back to your in-house cost estimate, your independent cost estimate that you did prior to the procurement. If they don't line out, if you're not within some reasonable portion or percentage of what you thought it was going to cost and what your low-cost bidder thinks it's going to cost, then you need to go back and look at what's happened. Perhaps there's an error in what you costed, or fee was unclear and people didn't know what to bid, but you do need to look at when you get that situation of a mismatch. One of the things that people have often thought is, well, if I just pick low-cost bidder, if I do a procurement and I choose the low-cost bidder, that is sufficient documentation of cost reasonableness. And HUD is very clear that it is not. You do have to have this in-house cost estimate, and you have to compare the cost estimate to the bid in order to look at whether you think it's reasonable. And if there is that mismatch that I talked about, you then either have to reissue the RFP because there was some confusion, you have to look at if there was an error in what you did and calculate your cost estimate, but you somehow have to screw up this process. If you're not doing an RFP, maybe you're just paying for costs in a developer. A developer is coming in and he's going to build some rental housing, giving you a bill or telling you it's going to cost him however much for the roof. How do you know whether his development budget is reasonable? And so the way that most people do this is through third-party costing software or in-house experts who would have a database or an experience with costing similar things. In costing software, there's a lot of good costing software out there. People use a range of different things. Marshall and Swift, RS Means, Xactimate. There are a number of different costing packages out there that people use to do what they think the scope of work ought to cost, and then compare it to what the developer is saying to see whether his line items are. But either way, you have to have a documentation that what you're paying for is reasonable given typical market costs. Okay, so that moves us on then to allowable. And so when we say allowable, what we mean is this is a type of cost which is both eligible under the program that is funding it and does not violate the kinds of allowable costs for any federal grants which are called out in Part 200. So there are some kinds of costs that, regardless of which federal program you're using, you can never, ever spend money on. So any federal grant can never spend money on lobbying or alcohol, entertainment, things like that. They just aren't going to use federal taxpayer dollars to pay for. And I think those of us who are doing this, or even folks who are new, this is fairly logical. Then there are some types of costs, like equipment, for example, or the pre-award costs that we talked about earlier, that depend upon the particular regulations of the program that is funding. So in our case, CDBG-DR. And so let's take equipment as an example. There are prohibitions in the CDBG-DR regulations about when you can and cannot buy equipment and which kinds of equipment are allowed and which kinds are not. So in this case, Part 200 would defer to CDBG, and CDBG would tell you you can buy equipment in these instances but not in this. So you need to go back to the CDBG regulations. The criteria in general for allowability has to do with first whether it conforms to GAAP, right? Generally accepted accounting principles. Is it the kind of cost that would be generally allowed, and that you've not double dipped, right? You haven't already paid for that same cost with your FEMA grant or with your CPA grant or transportation grant or whatever else you have. And again, you have documented this eligible implications of that particular program. Allocability. So when we say allocable, what we mean is it gets back to that indirect cost allocation that we talked about, that you can associate this cost directly with CDBG-DR, that you can reasonably allocate that cost back to what you are supposed to be doing, and that you've got a plan for how you're going to attribute it. So with the direct cost, right, you know that it's allocable to CDBG, CDBG-DR because you know it's a distribution expense, a direct expense. If it's an indirect cost, you've got your indirect cost allocation plan that has been approved, and therefore you've made the eligibility process. You've documented the eligibility process. Okay, so we have a number of other things that are covered in the super circulars that we're not going to do a lot of detail on. There are later webinars that are going to cover these in a little bit more detail, but again, we can take questions if people have them. So financial management system. This is one of the ones that the circulars actually did offer some additional guidance, or Part 200 offers some additional guidance. And really what they're looking for here is effective and efficient systems, things like internal control, that you have a process of safeguarding personally identifiable information, people's social security numbers, tax records, like that are kept securely. That you have good cash management procedures, that you have a way of monitoring and managing your expenses to make sure that they are in fact reasonable and eligible, documented, so all those sorts of things around good financial management. And one of the things that's important about CDBG-DR is that we have to have financial management procedures. And so one of the things that HUD will monitor you on is, do you have those procedures in place, and are you in fact following them? Many people will just borrow their financial management procedures from their overall agency or from their other HUD programs. I highly encourage you to go back and take a look at those and not just carry them over to there are things about CDBG-DR, about how you're going to report in DR-GR, the tracking system, the timing of what you have to do, overlay the federal requirements because it's DR, that I don't think you can just move your financial management procedures. In most cases, you're going to want to take those and tweak them for this context of what you have to do. And again, I think if the IG particularly comes out to audit those financial management procedures, some of the things that they're going to look at. The next thing that's covered in the super circular is procurement. For those of us who've done this, as I said, we know about Part 85 or Part 84. For those of you who are new, those are the old HUD regulations that used to cover procurement. Those have now been consolidated into Part 200. Honestly, there's not a huge amount of difference. There are a few things that have been made more clear, a few tweaks that have been made here and there, a few limits that have been changed, but the general construct of how we do procurement pretty much remains the same. If you are a grantee, you will have to have procurement procedures, and again, those are some of the ones that I guarantee you will get audited. So you want to make sure you have good procurement procedures, and again, probably tweak for the context of CDBG-DR. And you want to make sure that your procedures are compliant with Part 200 or the old Part 85, again, fairly similar, that you're following those federal rules. If you are a state, you actually have an option. You can either choose to follow Part 200 or you're allowed to follow state procurement law. Most state procurement law is actually much more stringent than Part 200, but you'll have to document that in document compliance with following rules. There are also for CDBG-DR some transparency requirements around procurement. And again, you'll have to look at your Federal Register notice about your particular appropriations to know what they are. But in most of the recent ones, there have been requirements around posting RFPs, posting the winning bidder, the information on the winning bidder, and other similar sort of things so that the public knows the procurements that you've done. Conflict of interest goes with procurement, as you know, and most of those requirements tie back to the bidding process and having objectivity in the bidding process. But there also are conflict of interest requirements around beneficiaries and their relationship to the funding, and whether you're funding anybody who has a relationship to decision makers in the funding process. So you do want to make sure you have conflict of interest procedures, and again, that you are carefully tracking and following. There are requirements in both the CDBG regulations and in Part 200 that talk about the source documentation that we talked about, backup for each of those costs, and also all the other things that you're doing, all the eligible activities, national objectives, and so forth. And there's if you're looking for a resource for kind of a checklist for this, if you go onto the HUD Resource Exchange, there is a good HUD monitoring guidebook that covers both regular CDBG and CDBG-DR, and you're kind of probably going to want to use both sections. And that will tell you the kinds of things that HUD's going to look for when they come out to monitor you. And you can use that as a starting point. You'll probably have to expand and augment for your activity type and for your program, but at least the starting point for what your records should look like. Finally, the super circular, there used to be a circular called A133 which covered audits. That's now been subsumed into Part 200. We still have audits when you're over a threshold. That threshold was increased to $750,000 from the old $500, and that's if you get $750 of any federal resource, all federal sources put together. You are required to do an audit, and if you are required to do an audit, then you are allowed to charge back the cost of that audit. And so there's again a lot more detail. That was one of the more significant changes when they consolidated all the circulars to 200. So if you're an auditing person, you might want to take a look at that if you have not already. So with that, I'll do our next poll, Chantel.
All right, thank you, Marcia. So for our fourth poll, we have which of the following costs would likely be okay DR expenses under the cost principles? An economic development project that provided a 30% return to the owner, cost to replace damaged countertops with new countertops imported from Italy. The independent, you have two cost estimates, independent cost estimate and lowest bidder estimate. Reimbursement of the state's Human Services Agency for temporary housing expenses, or a portion of the state's annual tourism budget. And the polls are now open.
Okay, and how are we doing, Chantel?
We have about 22%.
Okay, so let's just give it a moment. Again, take your best shot at it. We'll talk it through together. And some of these are a little bit, they're on the fence on purpose, so we can talk them through.
Okay, we're about 50%. You want me to go ahead and close it?
Yes, please.
Okay, the polls are closed, and I'm sharing. We have 6% voted economic development project that provided a 30% return to the owner. Only 2% voted the countertops. 58% voted independent cost estimate and the lowest bidder price. We have 30% voted reimbursement of the state's Human Services Agency, and 4% voted a portion of the state's annual tourism budget.
Okay, so let's go through each one of these. Thanks, Chantel. So obviously the first couple, I think not very many people thought these would be okay. So the first one having to do with the 30% return. Remember that we talked about cost reasonableness and necessity. So, one of those aspects of reasonableness is the level of return that is earned by for-profit beneficiaries. So we're talking here about businesses, we're talking about rental developers, and one of the key things about CDBG and also with the federal circulars is that those return on investment to those beneficiaries must be reasonable. Now, we don't know whether 30% is reasonable or not, but it's probably in the bounds of what would not be considered a reasonable return on investment to either the business or a rental developer. You'd have to look at the particular circumstances of your marketplace, and particularly if you're doing rental housing, for example, what's a typical kind of a profit that might be made by a developer given the type of building they're building. But, in no cases is it probably at the level of 30%. So that's probably not a reasonable expense under federal grant. Similarly, the next one having to do with replacing damaged countertops with new Italian granite. We don't do luxury in federal grants. That's one of, as I mentioned, there's certain kinds of things that just aren't done with federal taxpayer funds, and one of those is luxury items. And replacing with new luxury fancy granite would not be one of those things that we do. The next one, the independent cost estimate. So the cost estimate comes in at $1 million, and the lowest bidder is $1.1 million. And remember that I mentioned that it doesn't have to be on the penny, right? So you're probably not going to get your bids that come back in that look exactly what your cost estimate thought it was. And so you need to have some procedures that say, well, what is that range? What too low or too high is generally considered to be within the range of what I think my cost estimate, my bid should be. And in this case, this is a very minor distinction between the independent cost estimate and the lowest bidder. And so you would probably say that that was a reasonable, documented as a reasonable cost because it's within a reasonable range of what your independent cost estimate that it should be. And you'll want to define that. 10% range, is it 5% range, whatever you think is justified. Obviously, the caution is the larger you make that range, the less likely it is that the IG or the HUD monitors are going to think that's a reasonable, correlation. your cost estimate, low cost bid. So you want to have a, you know, a reasonably tight, but yet be practical. The reimbursement of the Human Services Agency. So the issue with this one is you're taking federal funds to replace federal funds. So what you've got is federal CDBG, who is using federal SSBG, which are HHS funds. And so you'd be paying federal money with federal money. And we don't, that's one thing we don't do. We don't use federal money to repay other federal money. There are a couple of exceptions to that is specifically allowed, but in general, federal does not reimburse federal. The next one is the annual tourism budget, and this is one we've actually gotten a lot of questions about. So if you looked at the Sandy appropriations and the Sandy waivers, you will have seen that a couple of grantees got specific waivers to pay for tourism. Those were costs for specific campaigns in particular storm-damaged areas with the idea of economic revitalization of those particular storm-damaged areas. It's not the come to our state campaign. It's not a part of the state's tourism budget in general. Particular campaigns related to the revitalization of damaged areas. So in this case, what we've got the state's annual tourism budget, and the idea is we kind of hope the state will come back. That's probably not going to be a reasonable CDBG expense because it's not directly attributable back to the disaster. Okay, so let's take any additional questions, Brandy.
Yeah, we've got about 4 or 5. So as a subrecipient, my budget is split between administration and grant delivery. How do I determine which part of my budget includes the activity delivery cost?
Okay, so that's a good question. So you're going to need to go back and look at what you're spending that budget on. It's, you know, there's not like a specific magical proportion that says it's 80-20 or something like that. You're going to have to go back and you're going to have to look at your budget and say, okay, how am I, you know, you've got probably a bunch of your budget is salary, I would imagine. So go back and look at the people who are included in that salary line item and say, okay, what job are they doing? And then say, okay, well, if I know that Susan, Bob, and Joe are all out there directly working with clients, they're, you know, doing counseling, they're overseeing housing projects, you know, whatever they might be doing that's directly related to a project, then you can take their salaries and include it within your budget for equity delivery costs. And if you have other staff where what they're doing is kind of making sure the subrecipient keeps managing the grant, reporting to the grantee, and monitoring your progress and all of that, those salaries would go to admin. And more likely what will probably happen is you'll end up dividing salaries based upon your best guess of how they're going to spend their time. So you're going to have to go back and look at all of those individual salaries and say, what do I think they're going to be doing? And therefore, what bucket do I put it in? And then the same would be true of other kinds of direct expenses, right? So you probably have costs for travel, you might have costs for machinery and equipment. And again, you're going to have to look at those things and say, okay, how are they being used? So if the travel, for example, is travel for the staff who are running around doing inspections, and they need to, you know, drive their car around and bill that cost back, then that would be an activity delivery cost. If, however, the cost is for, you know, buying the paper that you use in order for you to write your annual report or your quarterly report to HUD or to the grantee, that would be an admin expense. So you're going to have to go back and do your best guess on your budget about which bucket you put it in. And that's just for a budgeting purpose. Then what you're going to have to do is, as the costs actually are incurred, you're going to document those actual costs and true up your budget, right? Because it might be that if you hire somebody a little bit more expensive and so one category goes up, or maybe you spend a little more on travel than you thought. And so you're going to have to track that over time to kind of see how it ends up working out. But at the end of the day, in order to be sure you're comfortable that you're not going to go over the admin allocation that you have and that you're charging eligible between activity delivery and admin, you're going to have to dig deeper into what those costs are that are included in the budget and how they're being. Does that cover that one, right?
Yeah, I think a related follow-on kind of is, if you could talk in more detail about what level of detail is required in the timesheet, so like regarding different funding sources as well as within CDBG-DR, how you like allocate on your timesheet the time you're spending on different activities.
Okay, so let me give you kind of the ideal, you know, best case answer, and then we can talk practical. So time, you know, depends on what kind of timekeeping software that you use. There are some grantees, and this is the best case scenario, who literally track individual time, and this is particularly around activity delivery now, where they will track time down to the level of the beneficiary or the case that the particular staff was working on. So they'll have hours for project 1, hours for project 2, hours for project 3, hours for project 4, so that you can literally attribute the hours to project by project. And that way, if you have to go back and let's say that project falls apart, and therefore you have to move that time back over to admin, you have the timesheet that's down to that particular address so that you could then know what time you actually have to move. So that would be the sort of most complicated. And there are lots of software packages that would allow you to do that. You could set up a coding system that has a sequence of number codes, and you would just run a number code depending on what, each project would be sequentially numbered, or you number it by their application number, or whatever you want to, however you want to set it up. And then you'd be able to track the labor cost to each individual project or beneficiary whom you're working with. Now, that works if you're doing larger infrastructure projects, because you probably don't have a million of them. And so tracking your cost project by project is probably pretty practical and reasonable. Obviously, much more difficult to do if what you're doing is serving homeowners or businesses where that individual might talk to 15 people or 20 people in a day, much more complicated to do. So at a minimum, what you have to do is have the timesheet down to the level of the particular activity type, or the way you set it up in DRG, or whatever that grouping is on their timesheet. So if you set up, for example, all of your small business loans as one DRGR activity, that at a minimum the timesheet has to go down to that level so that you can attribute their activity delivery costs to, in my example, the business loan program, or the homeowner rehab program, or the rental rehab program, however you set it up. Now, again, in order to be able to track out activity delivery costs to projects in DRGR, you want to have the timesheet at a minimum match out to however you set it up in DRG. And again, there's a DRGR webinar coming up in a couple of weeks, so if you want to have follow-up questions about how to do that in DRGR, they can certainly walk you through that. But that would be the minimum level of specificity. The more precise is literally site by site, homeowner by homeowner. And again, that's up to you to decide what level you want to do it at. It's not sufficient to just do it at admin and activity delivery, those great big buckets like that, because then you won't know in DRGR how to attribute those costs to the particular activities. So did that cover that, Brandy?
Yes. And then it's 3 more questions if we have time. So it's part of ensuring reasonable costs. When are we required to do a market research in order to determine if the cost is reasonable? Market research analysis.
Okay, good. So CDBG never actually requires a market research as a requirement. Now that doesn't mean it's not a good idea. But there's nothing in CDBG that I'm aware of, and again, I'll ask the HUD folks who are on the call to join in if they want to jump in. But there's nothing that I'm aware of that says we have to do a market research to decide whether a cost is reasonable. Because usually cost reasonableness has to do with whether what I'm paying for that item is what a common person would pay for that item. That said, I think in some instances, and it's probably not a lot, but in some instances, it probably is prudent to do market research. So for example, let's say you're going to fund some sort of economic development activity, and you're worried that it won't fly, where it's going to happen, that you're going to put money into a particular grocery store, let's say, and that grocery store isn't going to work in the location that it's going to be. So that would be more sort of a feasibility analysis, part of your activity delivery if you're paying for it, or the project if the developer's paying for it. I don't think it's so much about cost reasonableness as more, is this a feasible project that I should really, really be funding? Probably part of that the right. But I don't know of anything in cost reasonableness that says you have to do a market study. Folks at HUD, do you want to jump in on that?
Yeah, this is Tyler. I mean, I'm in agreement, so I can't remember the exact language in the 2 CFR 200, but basically says costs that a prudent person would pay. So you would do your own. If you would use your own local government funds in that same manner, then that would be reasonable. Whereas you wouldn't go more extravagantly because it's now federal funds. But in terms of the requirement for the market study, I think that the example that you gave was a good one. And also, if it's a really complex or you're really unsure, you should always contact your CPD rep about a specific cost reasonableness question.
Good. Thanks, Tyler. Okay, Brandy, next one.
Okay, next one is, would cost estimating software be charged to activity delivery or program administration? For example, if we're doing like rehabilitation activities and they're using the software by a paid staff member, would that be ADC or administration?
Okay, good. So you're going to, what I think the person's talking about is all the costs and software that I talked about usually has a price. There's an annual subscription. Sometimes, depending on how you work the service, they might charge you per deal that you evaluate, or you buy the software. So if you can attribute those costs, if the use of that software is exclusively going to be used for, in your case, I think you mentioned housing rehab, but that's CDBG-DR eligible activity type, then you could charge it as an activity delivery cost. That annual subscription to the software or the purchasing of the software would be a reasonable activity delivery cost for the grantee or the subrecipient to undertake. Again, assuming you've procured it and assuming it's cost reasonable and all those things that we talked about, I think that would be okay as an activity delivery cost, assuming it is only being used for CDBG. The key thing would be, if you're also going to buy the software and then you're going to happen to use it for your home program or you're going to use it for your public housing construction or whatever, now we've got an issue with cost allocation. So assuming it's just being used for CDBG-DR and it's being used tied directly to an eligible activity that you are funding, and again being paid by the subrecipient or the grantee, and again it's cost reasonable, I think that would be an eligible activity delivery cost. Tyler, do you agree? Tyler, I think you might be muted.
Yes.
Okay.
Marcia, this is Tom. I agree as well. That was a good example.
Good. Great. Okay. Perfect.
Okay, and one final question for this batch, and it relates back to the poll that we just took. A question was asked about the replacement of the granite countertop. So if we are undertaking a rehab project for a home, and actually the homeowner happens to be also low moderate income, and prior to the disaster they did have hardwoods, they did have granite countertops, and in order to make them quote unquote whole, can we replace what they lost using CDBG disaster recovery? Would this be eligible?
So that's an interesting way to put it, Brandy. One of the things I think it's important that we, dispel right now is that CDBG-DR is not meant to make the whole. That's not our job. Our goal is to fill the gap in the cost of construction and to help people get back in their homes, but our job is not necessarily to put them back exactly or even better than they were, although of course we want them back in standard, decent, safe, and sanitary, all those kinds of things, housing. So I think it might come down to your policies and procedures for your program, and it probably depends upon the kind of granite and the cost of the granite, whether you can verify that granite is cost reasonable. And that's why when I did this example, I made it, imported from Italy with fancy new countertops. It's clear that would be outside the range of reasonable. It could be, and I've heard arguments from some grantees that, they can get granite for cheaper than what they can get, solid surface kind of countertops. That could be, and it could be that it's a very inexpensive granite. It could be that you can deem that to be cost reasonable in your policies and procedures. So it's not that granite is always bad, but it does raise eyebrows, and it begins to look like a luxury item. So I think if you're going to do things like that, granite countertops, hardwood floors, special fixtures, you have to be able to justify that that's a reasonable, necessary, typical construction expense in sort of medium, modest quality housing community. And you'd want to look at the cost of that as compared to the cost of putting tile or putting, whatever other kind of countertop. And sometimes what people do when they've gone through that analysis is they'll figure out what the cost of a tile countertop, let's say, let's say a tile countertop would cost $1,000. If the granite countertop is going to cost $5,000, such that it's considerably more and yet has the same function, then they'll subsidize the $1,000 and the homeowner can use their own funds for the extra $4,000. That's the kind of thing you're going to have to work through. And again, there's no totally hard and fast rules here, but you're kind of beginning to verge into the area where you're going to get questioned costs. And so I would certainly talk, before I did those kinds of costs, which an outside, observer might say sound like a luxury item, I would have a conversation with my HUD field office rep and work through what they feel comfortable with in terms of eligible costs. Hardwood floors, similar sort of thing. I will give you a heads up on the hardwood floors that one of the things that HUD has allowed are hardwood floors when it's an accessibility issue. There are times when the person is, mobility impaired and going over carpet and that kind of stuff is difficult for them. That's a good example of where a hardwood floor or a tile floor might be allowed. So I would say, for those kinds of kind of in the margin sort of cost, get it into your policies and procedures, treat people equally, and talk to your HUD rep to come to consensus. Tyler, Tom, you guys agree?
Totally.
Okay. Excellent. All right, so Brandy, it sounds like that's it for now, so let's keep going. All right, so timeliness, there's a lot more detail on this topic in your previous webinar, the first one that we did in this series. So if you want to have more deeper dive in this topic, please go back and look at those. But a quick overview, there are typically in the appropriations that come from Congress, requirements related to the obligation and the expenditure of your funds, how quickly you have to do that. It does vary by federal appropriation. So we have the Sandy example here. It might not be the same for your appropriation, whether you're older or newer. So you've got to go back and look at the Federal Register notice that HUD published to get the details of how it will work. We think the Sandy appropriation will probably be the model going forward. And what that one says is by September 2017, which is the end of the federal fiscal year for 2017, all the funds have to be obligated. And obligated means in a contract between the grantee and HUD, so the grant agreement. And HUD has allowed kind of that grant agreement to be a rolling agreement so that you can take, some of my funds now, some of my funds later, some of my funds a little bit later, but all of that all together, all of it has to be obligated by September 2017. So your federal appropriation might have a different end date, but there'll typically be a date at which all of your funds have to be obligated. And then, from the date of obligation, you have a certain period of time to get the money spent. And in the case of Sandy, that was 2 years. So 2 years from the date of obligation, have every penny drawn down. So when we say spent, we literally mean drawn out of DRGR and expended for an eligible activity. There are some waivers that can be had and beyond 2 years, but there's an absolute finite deadline that, again, your appropriation will have for the last date at which all funds. So you want to pay attention to the timelines as you're looking at expenses. All right, program income. So we're going to just do a quick overview of program income to allow a little bit of time for questions at the end. But there is a lot of great resources out there in CDBG on program income. So you'll see 2 regulatory sites, either the state sites and the entitlement site for program income. On top of that, though, and I think actually more important for DR purposes, your Federal Register notice that came out with your funding appropriation will describe program income and will describe how it can be used and its rules, because again, they have been tweaked over time. So make sure you look at your Federal Register notice, not just CDBG regulations. When we say program income, what do we mean? So program income are funds that come back to the grantee or to a subrecipient because I spent CDBG-DR funds. So the easiest example to think about is you lent money to, let's say, a rental developer, and that rental developer builds their housing, and then over time they pay back that loan fee. And that's principal plus interest on that loan. That money is coming back into the grantee as a loan repayment over the years. That money coming back in, regardless of when it comes back in, whether it comes back in tomorrow, next year, or 10 years from now, that money getting repaid, the principal plus interest, was due a CDBG loan, and therefore is CDBG-DR program income. Program income is only earned by the grantee, the money coming back into the grantee, or any entity that you have deemed a subrecipient, who again gets money coming back into. And we'll talk about what kinds of money in a minute, but it's only the grantee and subrecipient. So if we have a developer who makes money on a deal, or a business who's a beneficiary and makes money on a deal, that's not program income. Money coming back in to the developer, to the grantee or a subrecipient. So the 2 most common ways of getting program income, and we actually see quite a lot of it in DR, is real property that's acquired or improved with CDBG-DR funds and then sold. So let's say, for example, you as a grantee do a clearance program. And so in clearance and CDBG world similarly. So you go out and you acquire land and you clear the demolished structures off that you've now got, maybe it was damaged by the storm, and you've now got vacant. You turn around and you sell that vacant land to a developer or a business or a homeowner, whoever, and you get the proceeds of that sale to the grantee. That money coming back into you is program income. So you bought the land, cleared the land. Other common way, as I mentioned, is the repayment of CDBG. So you make a loan, to a business, you make a loan to a developer, you make a loan to a homeowner, they pay you back both the principal plus the interest, the entirety of that repayment, and however long it takes for them to repay you, all that is program. Those are the two most common that you're going to see in CDBG. There's a lot of other sort of complicated types of program income that could happen, but those are really the far and away the most common. And if you do have any other kind of income coming in, I encourage you to take a look at the Federal Register notice to see what is defined as is and is not program income. We'll define not in just a moment. The other thing people get confused about is program income versus applicable credits. And applicable credits are typically, but not always, earned by fees that you might charge for something, like de minimis amounts of, you can't charge a big application fee that to preclude participation, but maybe you have small fees or something to do. That's an applicable credit. It's an offset against cost. And again, the HUD notice that we mentioned earlier has a good description of what those are, particularly the OMB notice, and the description of the notice that describes how the OMB circulars work. That notice has a really good discussion of applicable credit. So that was notice 21501, if you want to look at that. Okay, so what is not program income? So again, this is going to differ by your appropriations. You're going to have to go back and look at your Federal Register notice. But in general, most of the appropriations have allowed for a very de minimis amount of money that is earned on an annual basis to not be considered program income. So if your entire grantee, every bit of CDBG program income, CDBG-DR program income for this allocation that you earn, add it all together for the year. If the sum total of all of that, in the most recent ones it was $35,000, and others it used to be $25,000, so whatever your threshold is, if the total of all of that is less than, in this example, $35,000, then that money is not considered to be program income, and you may do with it what you will. Now, it's not that the first $35,000 is free, and then everything over $35,000 becomes program income. Once you go over 35 for the year, everything is program. The first dollar all the way on through. So the risk of guessing that you're going to have less than $35,000 is that if you go ahead and spend that money as if it were free, and then you later find out that you went over 35 because somebody prepaid a loan or you got a payment you didn't expect, now you're in trouble because you haven't spent the funds appropriately. So my caution to people is, unless you're absolutely positively sure that all of your income in its entirety, all the money you might get back, not program by program, but all of it, is $35,000 or less, or whatever your threshold is, treat it as if it's program income. So that's not program income. And again, look at your notice to see what your cutoff is. If you have funds that are done by what the entitlement program calls a community-based development organization, or a CDBO, the money that's retained by that CDBO, if they do an eligible community revitalization, economic development, or energy conservation activity, and they earn money from that, they get to keep it. They don't pay it back to you. Then that money is not program income. And in the state program, that's called a 105A15 activity. And there's a lot more detail about who qualifies, what kinds. It's only nonprofits, and it's only special kinds of nonprofits, and it's special kinds of activities. So if you're thinking about funding nonprofits to do community economic development, neighborhood revitalization, or energy conservation, look at 105A15 of the statute, and it'll give you more guidance on who qualifies and how it works. Finally, funds which don't go back to a grantee or a subrecipient. So if a developer makes money, if a business makes money, and they get to keep it, that's not program income, although you would need to make sure you haven't over-subsidized them and that it was cost reasonable. Okay, so obviously you have to have a process for tracking all of this, because you have to know what program income came in and how you spent it, and so you need a process, a set of procedures around program income. One thing to know in program income that is confusing, you don't literally send the money back to your line of credit. It stays with you as your grantee, and you track and report its progress in DR/GR, so you don't literally cut a check back to HUD for purpose. All right, let's do this last poll. We just have a couple more slides yet to go.
Okay, so for our fifth poll, we have which of the following payments are not program income? Principal plus interest on a DR loan repaid to a grantee. Private business gets a DR loan and returns to profitability. A grantee buys land using DR and sells that land to a developer. or a CBDO makes DR small business loans under 105A15 and receives payments. Okay, the polls are now open.
Okay, in the interest
And
of
the
time,
answers are,
go
I
ahead.
was just going to say the answers are rolling in. We have about 34% voted so far.
Okay, well, let's go ahead and close it just in the interest of time.
In the interest of time, okay. The polls are now closed, and I'm sharing the results. And we have 9% the principal plus interest on a DR loan repaid to a grantee. 48% voted private business gets a DR loan and returns to profitability. 16% voted grantee buys land using DR and sells to a developer. And we have 28% voted the CBDO makes DR small business loans under 105A15.
Great, thanks, Chantel. So let's go through each of these. So as I mentioned earlier, the principal plus interest on a loan that gets repaid back to a grantee is always program income. So that first one is going to be program income. The private business. So if the private business gets a loan or a grant from us, and that then enables them to get back on their feet and they start making profits because they're now healthy again, that's exactly what we want. And as long as they get to keep that money and they don't pay it back to us, then that's not program income because it's being retained by a beneficiary. Now, again, we need to look at reasonableness and make sure we haven't over-subsidized them, but in general, that's not program income. We talked earlier about the idea that if I buy land as a grantee and then I clear it and I sell it, that money coming back into me when I sell that land is program income. It's coming back into a grantee. And then finally, the last one, a CBDO that goes under one of those three eligible activities, which would include economic development, and assuming they've qualified as a CBDO and all the other activity types, the eligible activities, and that CBDO does an eligible activity and it gets money back in, that money that comes back in and is retained by the CBDO or the 105A15 organization state program, that money is not program income as long as they get to keep it. If they have to then pay it back to a subrecipient or pay it back to the state or the city, then it is program income. Okay, so what do I do with program income? So I actually have to follow all the CDBG rules, right? Tied to the storm, eligibility, including all the CDBG-DR rules. So things that had to do with a disaster, the duplication of benefits, tied to the storm, none of that gets washed just because it's program income. So however long it revolves, all of that still has to be eligible. That includes the 50% eligibility target, the 50% low mod targeting that's required, also applies to program income. All the other federal requirements apply too, so fair housing, Davis-Bacon, environmental. Again, it's just as if you have another dollar of CDBG-DR. On the flip side, just like regular CDBG-DR, we get to take 5% of it, and we talked about that earlier when we talked about the cap. We can take 5% of it for program admin. Now, if you're going to be getting program income, you have to describe in your action plan how you plan to use it. Is it going to be more of the same for my existing programs? Am I going to use the program income for a different kind of program? What's my plan for how I'm going to use it? And HUD actually lays out a couple of options for how you can think about your program income. And again, these will be specific to your particular Federal Register notice, so you need to be cautious about it. But generally, the options are as follows. You, the grantee, could keep the program income. So it all comes back into you. Everybody pay all the program income back to you, all your subrecipients. And then you have to spend that program income before you draw down any new money out of your DR-GR account. So the program income is coming back in, it's sitting in your bank account at the grantee. You draw down that bank account before you're allowed to go back and start drawing out of your DR-GR account. Any money on hand that the program income gets spent first, DR-GR. The downside of that, don't forget, is that we talked about those expenditure deadlines that are ticking away in the background. So the more program income you have and the more you have to spend it, the slower you're going to be to spend out of DR-GR. So think about balancing that. You could also allow your subrecipients to keep the program income. So rather than making the subrecipients pay it back to you, you let the subrecipient keep it, and they have to spend it before they can draw any more money from you. So let's say you let your state and you allow the city to keep the program income. The city can't do a new draw request until it has spent the program income it had on hand, but other cities and the rest of the state can keep on drawing. We could take program income and put it into a revolving loan fund. And so we take, it's not that we're capitalizing revolving loan fund with grants, we're not. We're taking the program income and we're putting the program income in a revolving loan fund and then lending it out for additional CDBG activities. That revolving fund has to have a specific purpose, not just all program income. You designate it for a particular activity type. So it's for small business lending, or it's for housing rehab, or it's for rental rehab, or whatever the purpose is. And then the next bill for that purpose gets paid out of the revolving loan fund, and the other programs, the kinds of activities you're doing, continue on their merry way. You could also set up, if you're a state, you could set up a revolving fund where instead of funding a specific activity type, you're going to use that fund to make awards to units of local government. So you'll set up a program where you make loans to the state or make awards from the state out of the RLF units of local government. And the last option is you could take your program income and you could transfer it to your regular CDBG program. So rather than being CDBG-DR, you move the funds over to your regular state or entitlement CDBG program. The funds become regular CDBG funds, and they have to be written up in your consolidated plan as part of your regular program. And they lose all their CDBG-DR requirements, but they also lose all their CDBG-DR waivers. So they become regular CDBG funds. And those are your options for how you can use your CDBG-DR funds. Okay, so let's take our last bit of questions, Brandy.
Okay, we have a question around liquidated damages assessed against a contractor who is being paid using CDBG-DR funds. Would that be considered program income even if those funds are being rolled back into the project?
Okay, so you have a contractor who does something wrong, you have them make a damage claim, and you make a damage claim against that contractor, and they pay, I assume it's some sort of fee or a fine, basically, that they're paying back to the grantee. Oh, that might be an applicable credit. I'm not sure about that. I want to turn that over to Tyler. What do you guys think? Tyler, I think you might be muted. Or Tom?
Sorry, I'm poor at mute. I don't know the answer either. I'm wondering if Tom or the other HUD folks, but it does sound like an applicable credit to me as well.
Marcia, yeah, that's sounding like an applicable credit, but I think the grantee would need to run it through the CPD rep because it can get really tricky depending on the nature of the repayment.
Okay. So sorry, that's not a very clear answer to whoever asked it. I think that's right. I think you should talk through with your HUD rep the specifics of the circumstance, and maybe they can walk you through. If you need an immediate answer, you might also go back and look at that O&B notice that I mentioned that has some descriptions of applicable credits versus program costs. All right, the next one, Brandy.
Okay, and then the next one is with the 2-year clock in DR for the PL 113-2 allocation, are there any provisions to allow us to spend our regular grant funds before we draw down program income?
No, unfortunately, I know that this is a challenge with the 2-year clock ticking and with the expenditure, the expenditure deadlines. But unfortunately, the rule is the rule. It's program income on hand, unless you have put it in a revolving fund for a specific activity purpose. You have to spend the program income first before you're allowed to draw out of the RGR.
Hi, Marcia. Marcia, yeah.
So Marcia's exactly right. Yeah, this is Tyler.
Tyler and then
Sorry, now we're all talking. Marcia, you're exactly right. Some grantees have requested waivers of their CPD rep, and it's a very specific waiver. It's not a wide-ranging waiver. So there are opportunities to look at program income in a different way, but you really want to start that conversation with your CPD rep.
Okay, and Sandra?
Hi, Marcia. I was just going to point out that the Federal Register notice for their particular DR grant may not have a 2-year clock. The clock may be a different time frame. So it might not be as big of an issue as those who have a 2-year clock.
Well, yeah, so what Sandra's referring to is for the NDR grantees, most, if not all, received more or less, requested and will receive an automatic waiver of the 2-year expenditure deadline that will allow them to expend their program funds until 2022. So they have the same requirement, but the OMB gave us the waiver authority, or the ability to grant an extension. For the Sandy grantees who are doing partial obligations and are doing 2-year extensions, Sandra, it's actually a great point. If you're running into a situation where you've got program income on hand that is preventing you from fully expending your grant funds and you're approaching a 2-year expenditure deadline, you should work with your CPD rep to request an extension of the expenditure deadline for at least that amount of funds, so that you're not at risk of having to return those funds to your or basically forfeit those funds.
Exactly.
Right, and Tyler, I'm also referring to the South Carolina and Texas new Federal Register notice that will be issued soon also.
Yeah, so that hasn't been published yet. There is no statutory requirement on the 2-year expenditure, but I believe that there is some consideration about other means of expenditure deadlines. But yeah, you are correct, Sandra. There is no statutory requirement.
That's what I was going to say, guys, is again, you have to go back and look at your particular appropriation, because I know we have folks on the phone who actually are older than Sandy grantees. So you're going to have to go back and look at that issue in terms of what your expenditure deadline is for your particular congressional appropriation. Okay, what's the next one, Brandy?
Is there a sunset on program income generation? So is there a time when you don't continue to generate program income?
Well, we'd love that to be true, but unfortunately it's not. Yeah, program income is program income in perpetuity. So technically, although obviously it sort of loses the practical point of view, but technically it remains CDBG-DR program income 20, 30 years from now if you were still happening to earn income at that point. That's why HUD allows, at some point where it becomes kind of silly to continue to try to tie it back to the storm and all those sorts of things, they allow you to eventually say, okay, we no longer have any disaster recovery needs. We're going to take the money and put it over to our regular CDBG program. But there's never a point at which, assuming it's still coming back into the grantee or still coming back into a subrecipient, there's no point at which it stops being program income.
Okay, I think that's it.
All right, great. Well, HUD, anything else? Anything you want to add on that last point?
No, and also in terms of program income, in the later appropriations, grantees can explore the possibility, I think Marcia covered this, of porting their program income over to their state or entitlement program. So if you're in program income binds, explore with your CPD rep all of the situations that you have available to you.
Great. All right, anybody else at HUD want to jump in?
No, Marcia, I was just going to say we're out of time, so if you want to just refer to the resources very quickly and close this out.
Yep, so this is the last resources slide, guys. So again, this will all be posted on the website. I encourage you to take a look at those, and I think there are a lot of terrific resources that help you through these cost issues. So with that, I'm going to wrap us up. Thanks to the HUD staff. Thanks to all the attendees who are with us. Glad to have you, and please join us for the remaining of the webinars. Thanks, everybody.